Welcome back to today's explainer. If you've ever felt like your money is working way harder for your bank than it is for you, well, you are definitely not alone. Today, we are diving into a financial strategy mapped out by Chris Naugle, and it's often referred to as the infinite banking concept. Our goal today is to unpack the source material and see exactly how this whole strategy proposes putting you, not the bank, right back in the driver's seat of your personal finances.
Here's our roadmap for today. We're going to cover 1. How traditional banks profit. 2. The infinite banking concept itself. 3. Earning the spread. And finally, 4. Plugging financial leaks. All right, let's jump right into section 1. How traditional banks profit.
To really get the proposed solution, we first need to look at what actually happens the second you hand your money over to a bank teller. It kind of flips our normal understanding of money totally upside down. Let's look at Naugle's example. Say you save up $100,000 and deposit it into a bank. Well, to you, that deposit is an asset, but to the bank, it's actually a liability because they owe you that money plus interest. Let's say they pay you a pretty generous 4% interest. To turn that liability into a money-making asset, the bank immediately turns around and lends your money out to someone else. They might charge that new borrower 7%, 8%, maybe even 12%. So the bank is effectively using your money to make a profit for themselves. They're taking very little risk. And hey, they don't even have to call you to ask for permission.
According to the source, here is exactly how those numbers stack up in the real world. When the bank lends your money out for a mortgage, they might charge 7%. When that money eventually cycles back into the bank, they lend it right back out for a car loan at 8%. Then maybe a home equity line of credit at 9%, and a debt consolidation loan at 12%. Now, if you add up the spread the bank is making on all these change transactions, and then minus the 4% they pay you, the source calculates the bank is making a massive net spread of up to 20%. Yeah, the bank makes 20% while you make 4%.
Looking at those numbers, it's pretty natural to feel a bit left out of the profit cycle, right? So the million-dollar question is this. If the bank is making all this money by leveraging your savings, how do you change the game? How do you effectively become the bank yourself? Which brings us to section 2, the infinite banking concept. Let's clearly define what this alternative ecosystem actually is. A lot of people mistake infinite banking for just being a financial product, but according to the source, it's not a product at all. It's a process. It's simply the strategy of taking back the banking functions in your life. You aren't changing your current cash flow, and you aren't working any harder. You are literally just changing the institution where your savings are deposited first. So instead of putting your savings into a traditional checking or savings account, you redirect it. So where does this strategy suggest you put it? Well, the source argues that historically, the absolute most financially stable institutions for this are mutually owned life insurance companies, specifically using specially engineered whole life insurance policies. Why? Because these policies offer a whole set of perks traditional checking accounts just don't have. First, you get guaranteed interest, usually between 3% and 3.75%. Plus, because they're mutually owned, you actually get a share of the profits through dividends. Just as a quick side note, the source cites a projected combined dividend crediting rate of 5.9% to 6.6% as of March 2026. On top of that, the internal growth is tax-free. The funds are often protected from judgments and liens, which basically means creditors usually can't touch it. And it provides a probate-free death benefit, so your family gets it without dealing with a lengthy court process. But wait, there is a very important catch mentioned in the source material that you absolutely need to be aware of. You can't just go out and buy a standard off-the-shelf whole life policy. These specific policies have to be perfectly engineered for high early cash value so that you can access your money almost immediately, usually within about 30 days. To actually structure a policy this way, the life insurance agent has to give up 60% to 90% of their own commission. As the source warns, a lot of traditional agents won't even know how to do this, or frankly, they just won't want to because it directly shrinks their payday to fund your early savings.
Let's move on to section 3, earning the spread.
Okay, let's look at the difference in how you actually access your money, because this is a huge shift. In a traditional bank, if you deposit $10,000 and then withdraw $10,000 to buy something, your account balance drops to zero, right? You completely stop earning interest. But in the infinite banking concept, you don't actually withdraw your money.
Instead, you take out what's called a policy loan. Your original money stays exactly where it is and keeps compounding, while the insurance company loans you money from their own reserves. They just use your cash value to collateralize or secure the loan against your future death benefit. So the absolutely crucial point here is the math. Let's say your policy is earning that combined rate of 6% we talked about. And let's say the insurance company allows you to borrow their money at a simple interest rate of 5%. Because your money is still sitting there earning 6% and you're only paying 5% on the loan, you are effectively earning a positive 1% spread on money you're actively out there using. Just like a traditional bank makes a spread on your deposits, you're now making a spread using the insurance company's money. Which leads us perfectly into Section 4, plugging financial leaks. So what does this actually look like for an everyday person who's just trying to manage their debt? Well, the strategy suggests that the greatest opportunity to build wealth isn't always out there chasing high-risk investments, but actually just managing the debts you already have. The source uses a really vivid analogy here. Every debt you have represents a hole in your boat. Think of your monthly credit card payments, your car loans, student loans, they're all constant leaks. Every single month, money flows out of your family's financial system and right into a third-party bank system, and it's gone forever. The entire goal of infinite banking is to plug those leaks and redirect that water, that cash flow, back into your own boat. Let's break this down with a super concrete example provided by the source. Imagine you have two debts. First, a credit card with a $4,000 balance at a painful, wallet-draining 20% interest rate. That's costing you $100 a month just in interest. Second, you've got a car loan with a $4,000 balance at 5%, costing $350 a month. So in total, you're $8,000 in debt, losing $450 every single month at an average interest rate of 12.5%. Now, the strategy views this 12.5% loss not as a burden, but actually as a guaranteed rate of return that you can recapture if you play your cards right. And here is the exact 3-step playbook to do just that. Step 1. You take an $8,000 loan from your life insurance policy at that 5% rate we discussed earlier. Step 2. You take that $8,000 and completely pay off the credit card and the car loan. Boom. Those third-party debts are instantly wiped out. And step 3, actually this is the most critical part of the whole thing, you do not stop making those monthly payments. But instead of giving that $450 a month to Visa or Ford, you pay that exact same $450 monthly back into your own policy as a loan repayment.
Look at how fast this snowballs. Because you're pumping $450 a month back into your policy, you end up paying $5,400 back over that first year alone. That drops your outstanding loan balance from $8,000 down to roughly $2,600. And because the insurance company charges simple interest, your interest fee drops dramatically. In year 1, 5% of $8,000 was $400. But for year 2, 5% of that remaining $2,600 is only $130. All the while, remember, your original cash value is still compounding and growing in the background. You've essentially recycled the money you were previously losing to credit card companies and used it to aggressively pay down a simple interest loan, keeping all that wealth right inside your own system. So, summarizing the source material, the ultimate promise of the infinite banking concept boils down to this. You can build wealth through your own existing debts and expenses without changing your current cash flow, without taking on scary stock market risks, and without working a single hour harder. By simply redirecting your savings into a specially designed whole life policy and then borrowing against it to pay off your high-interest debts, you effectively act as your own bank. It's definitely a fascinating way to rethink personal finance, isn't it? Shifting from a depositor mindset into a true banking mindset. And it really leads us with a critical question to ponder regarding our own financial setups. Ultimately, who is really calling the shots with your money? You or the bank? Thank you so much for joining me for this explainer. I really hope this structured breakdown helped decode a fairly complex topic into something practical and easy to understand. Until next time, keep learning and stay focused.